Hello traders, it's Friday, July the 12th. This is John Kicklighter, Chief Strategist for dailyfx.com, here to give you your FX market wrap-up for the past 24 hours and now for what we can expect in the final 24 hours of this trading week. Now, I was out the past session, the Wednesday trading session. Of course, that's going to require some interpretation as well because we have seen some incredible volatility that has flown out of the developments that we had on Wednesday, particularly Bernanke's commentary. To dive right into it, we've had some extraordinary volatility, particularly from the FX market, if you were looking at the traditional volatility measures, but the implications of the commentary that we've had has certainly had market-wide impact. This is the U.S. dollar. All right, we've been talking about the dollar index for the dollar index for quite some time, and how its positive correlation to the S&P 500 has been quite remarkable. All right, why? Because the S&P 500 is a risk-based asset. All right, it typically reflects positive sentiment when it rises, and the U.S. dollar is the world's reserve currency or a safe haven currency. Thereby, it should rise as investors are looking for safety, moving away from the risky assets. So, under normal circumstances, under a market that is led by risk-based trends, you would expect that they are moving in opposite directions. That has not been the case between these two, however, as you can see. That is until this past Wednesday session. All right, the deviation from these two, this is actually the intraday price action between the two of them, has actually seen a dramatic correction to that theme. What was the catalyst for this move? It was the commentary offered up by the FOMC minutes, all right, as well as Ben Bernanke's commentary that followed them. Now, the FOMC minutes were the most important thing. What was the takeaway from that particular event? The commentary that we're really looking at is actually more confusing than it is encouraging. From this 50-plus page document, the thing that was most interesting was the breakdown, the rough language of breakdown between how many policy officials were expecting a taper in before the end of the year or potentially fully stopping their quantitative easing program before the end of the year, and those that expected it to go into 2014. So the language that was really causing confusion was that many, all right, using that word, that's their word, many expected they would not taper stimulus until there was a clear improvement in the employment sector, all right, and labor. All right, so that's many. Then we heard that several would expected that the FOMC should be cutting QE, or a QE taper would be warranted sooner rather than later. All right, that is a nice comparison. But then we also had the mini term once again, suggesting that bond buying could actually stop. But before we actually get, or sorry, it's more than half would think that, or just around half. It's really difficult to interpret what they're saying here, but around half of the members expected that we could actually stop bond buying before the end of 2013, versus many that thought they could see buying into 2014. All right, now you can see many, roughly half. These are loose terms, and the market is having a hard time trying to keep up with what way the central bank is leading. Are we going to get a taper before the end of the year, or is it going to be in 2014? What's the probability of it happening in September? All right, the markets are supremely confused, but you can see that they have certainly reacted in the opposite direction of what we were seeing following the rate decision back in June. All right, the dollar index came back for two very stark and aggressive selling days through this Thursday close. All right, this certainly takes this market back a peg, or this currency back a peg, and the S&P 500 has continued its rally. This is the CFD based on futures, rolling futures contract. And you can see this is the longest such run for this particular measure since way back here in September of 2009. Counting it at 9 consecutive days, we need one, or actually 2 days to make it consecutive. So this is actually 9. If we go to the spot or rolling futures contract, the count is a little bit different, but still, regardless, very remarkable. The futures market, All right, as you can see here, it has been 8 consecutive days of advance for the S&P 500, and that has been done. We've seen actually a greater run back here in March. Right before that, it wasn't since the beginning, or actually the very beginning of 2010. And then we have the spot index. All right, this was 6 consecutive trading days to the upside. We've had actually quite a few 6+ days of advance from the spot index. In fact, I was looking at the measure of 5 consecutive days and higher. How many consecutive 5-day runs have we seen? Actually 42 since we marked this bottom back here. That is a lot of 5-day rallies for this market. All right, just a measure of the consistency that we have come to expect from this constant driver here. But regardless, this is a market that has moved to yet another record high close. It hasn't taken out the previous swing high, the intraday high that we had on May 22nd, before Bernanke first set the market in motion to fear the taper. But we have set a new close, and that's what investors are really looking at. This is a consideration that we should really take in. Is this necessarily a positive risk-based move, or is this just a relationship to stimulus? All right. The concern on my part is this is not an even risk-positive move. How can we tell this? Well, we can compare the various markets that would reflect on risk trends. All right. Yes, the S&P 500 is rising. This is a risk-based asset. Yes, the U.S. dollar has pulled back a little bit. That is a safe haven asset. So those moves support a risk-positive scenario. However, when we look across different asset classes, the mixture really starts to come apart. This is the intraday performance from the S&P 500, the dollar, which is actually inverted, the Aussie USD, the Aussie yen, which is a carry trade reflection, Nikkei 225 futures, right? That means global equity markets performance. How have they all performed since we actually had the FOMC minutes, which was the big driver here? All right, well, as you can see, a number of them actually have shown incredible performance, incredible reaction after the event risk. We start off with the S&P 500, the blue line here, which has done quite well. Nikkei 225 futures have been volatile, but they are refusing to show strong follow-through on the same level. The dollar index certainly has dropped, or since this is inverted, it's performed as would be expected alongside equities. But look at the Aussie USD. All right, this should be a carry trade, and especially with the dollar weakness, this should be doing quite well to the upside. It absolutely is not, as you can see here with the Aussie dollar. Tentatively broke that trend line in that 20-day moving average and came right back down, partly due to the Aussie data, but you wouldn't expect this if you had a strong risk-based trend. All right. And then we get into the Aussie yen, the heavy carry trade performance. The carry trade should have absolutely done well if we were indeed seeing a positive sentiment situation where people would build up the carry trade, shorting the yen, especially the yen, considering that we have a Bank of Japan policy effort to drive that currency down. All right, that should be something that doubly leverages the effort to the upside. But as you can see here with Aussie yen and Kiwi yen, both of these have pulled back significantly. Pairs like the euro yen have gone nowhere. Pound yen, this is actually a 1-hour chart, have gone nowhere. All right, it was only the dollar yen that really had shown its retracement, and that retracement was developed specifically because of the weak dollar. Now remember, we were talking about how the dollar was one of the best opportunities out there, because whether you're talking about risk aversion, so the S&P 500 dropping, or whether you're talking about the dollar dropping, either or, you're going to have a big push or a downward pressure on the dollar yen, as long as one of those themes was actually active, proactive, giving us momentum to the downside. So we have had this break to the downside. While I was out, I took a small position in it, but I did trade out of it relatively quickly because of the exceptional volatility. But I guess that really doesn't count because I wasn't able to tell you guys about it ahead of time. I am watching to see, this is a 2-hour chart. You can see this is a very tight wedge. We'll see if there's a break from this wedge. I'd prefer a continuation. To see this move a little bit lower might be worth a test position from myself, and then if it breaks these previous swing lows, I might build it up. We'll see what happens, but the same suggestions apply. If the dollar continues to sell off, the dollar yen to the short side looks good. If the risk sentiment, the strong risk positive trend from this benchmark stimulus related risk asset continues to, or actually marks a strong reversal, it can take down those various assets that have not performed alongside risk-based trends, most notably the high-yield carry trades, right, like the Aussie yen and the Kiwi yen, which are already pulling back. You give a risk aversion theme from a natural correction from something like U.S. equities, it can amplify this move and thereby give another push for the dollar yen to the downside. But it won't be just the dollar yen that performs. You'll see most of the yen crosses. You can look for it in the Aussie yen or the Kiwi yen. I do like it most in the dollar yen and euro yen, however, because we can have a risk aversion move and a dollar weakness, and together that would be a very, very strong wind for the dollar yen to the downside. But I do like the euro yen, and I actually have an active pound yen short right now. This is, as I said, 1 hour chart. You can see that we have tentatively broke this trend line here, all right, but it has not shown much in the way of follow through. It's turning congestion just like the euro yen. We've gotten to the top of this channel range fib. All right, nice collection of, or confluence of technical resistance held there, and I'm in at around 150.35. I placed my stop up here at 150.85, I believe. So 50 pip stop. We'll see what happens. It's a small size position because I cannot be very confident in these markets until I see some consistency one way or the other. And this definitely does not have fundamental consistency yet. The best thing to get a yen cross reversal is to really see risk trends taken apart. And that could be done just by a natural correction, as I said, with this incredible run. Though you do not want to outright trade a short side move against this equity momentum. It is just simply backed by momentum. Regardless if you think it doesn't make sense or not, it's irrelevant. The market is keeping that momentum in place. So into the final 24 hours of this trading session, it's a reason to be concerned, reason to keep at least your wits about you. We have some notable event risk, notably two policy officials, or actually three, speaking. Williams, who is a non-voter, Plosser, who is a non-voter, as well as Ballard, who is a voter. All of those, all three of them, will be speaking. We also have the University of Michigan Consumer Confidence, looking at how data performs from the United States as a measurement of sentiment for the market. And then we have two very important earnings reports. JP Morgan and Wells Fargo. Watch the banks and the financial sector in the United States, because that's not just a measure of corporate profitability. It also is a measurement of how the financial sector is doing and how spreads are doing for investors. All right. So that's going to be an important mixture of fundamentals to keep a close eye on. One of the bigger concerns that I have outside of just the individual dollars volatility, I'm watching also the euro dollar. All right, this thing has been extraordinary in volatility. One of the biggest two-day advances we've seen from this pair on record. An incredible move. The problem is that, yes, the dollar weakness certainly was overdue in the short term with that big ramp, but the continuation to the upside, how long can the dollar continue its drop-off, and does the euro really represent that much strength? There is a significant problem with that thesis, in my opinion. When we look at the event risk, or the developments we've had over the past 48 hours, some very disappointing data from Greece. The unemployment rate ticked higher. You have Portugal's president actually calling an early election and throwing them into even more political turmoil. You have uncertainties with the bailouts for Greece, or getting that payment. We have Italy with a very disappointing 30-year bond auction just this past session, following its downgrade to a BBB status, 2 steps above junk rating. All right. so much unfavorable, uncertain event risk coming out of the euro. The euro has not necessarily moved to, reacted to it. My euro Swiss, I was trailing at the stop, and I did get trailed out. It was worth, I believe, 115 pips, a relatively good return. I'm not going to complain. I think it could have had more, but this is a slow pair, and you must have patience. And I don't necessarily want to stick with it if it's going to be that choppy. I also am keeping a close eye on the euro pound. The pound itself is not doing that well, but against the euro certainly is a very troubled currency individually. My biggest hit, though, from the past 24 hours, or past 48 hours, has been the Euro Aussie. I was taking a small position to see how this head and shoulders pattern after this trend line break was going to play out. It wasn't in the green for very long, and having got in around right here, it was in the green a little bit, but then it just completely reversed and stopped me out for 150 pips. That's why That's why when you place your positions, you must size up your position according to where your stops are going to be. Don't try to place a stop on a standard or full-size lot and try to work from there. Position size according to where the technical levels are. That's the best way of doing this, but this certainly stopped me out on that position. Does it have potential to once again move lower after that break? It does. All right, it does. But I'm not going to try to go for it unless I see something that really encourages me, like a pickup in the Aussie dollar, which is difficult to do considering that the Aussie dollar is struggling even though we have this risk-positive theme. More likely we have a risk aversion, the Aussie dollar will get hit even harder for it. I think that the euro certainly is a troubled currency, but if the market's not going to run with that theme, I'm not going to try to trade against it. A couple other non-risk-based setups, or further from the risk epicenter. I like the pound kiwi as it tests this former support here as new resistance. This is going to be just as troubled as euro Aussie. Don't have any misconceptions about that, but it should be worth looking at to see as either a reversal or breakout. The Aussie CAD has changed this inverse head and shoulders pattern into a descending wedge because now we have a common floor. We'll see if there is a break one way or the other here. It should be good for some interesting price action. Dollar CAD is very much a dollar-based reactor. Not much in the way of event risk from the Canadian dollar is going to move this. Though next week we do have the Bank of Canada rate decision, and the first commentary that we're going to get from the new Bank of Canada governor, Paulos. We'll see what happens there. A lot of interesting price action, a lot of volatility. You must be very careful. All right, this is not a market that is running purely on the risk-based themes, which would make it relatively easy. In fact, if we were looking to see how the markets have performed on a risk plane, all right, this is since May 22nd when Bernanke first mentioned the taper, and this is the spread. All right. If you were expecting the market to be running on risk, all of these would be moving in the same direction and should be moving at the same pace, all right? But in fact, you're seeing Treasury yields rise as Treasuries drop off, all right? You're seeing the risk-reward index has taken a tumble. The S&P 500 has picked up, and it's building its momentum. You have the commodity index slowly picking up, and you have the carry trade in the Aussie yen pulling back. This is not a consistent measure of risk trends. What are we supposed to take away from that? We are not seeing either a strong risk aversion move that would help out the U.S. dollar to the upside, nor are we seeing a strong risk positive move, which would otherwise help the S&P 500 and keep it consistent. So you do not have that consistent theme at work. So do not look for medium-term trends one way or the other towards risk. Look for developments that fall outside of that, consistency in the dollar despite risk trends, a potential pullback in the S&P 500 if risk aversion does kick in. All right, the risk aversion kicking in holds a lot more potential overall in these markets for moving them if it does occur, much more so than a positive turn in sentiment, because we don't really have much room for a really strong return to sentiment as we are already climbing essentially record highs on these benchmarks for return. So keep your expectations measured in exactly what we can expect. There's a lot of trading opportunity in pairs like euro dollar and pound dollar after the very aggressive runs. Dollar yen, which can break one way or the other, most likely going to follow both the dollar or risk trends, but at this point it's probably more the dollar, so this is more of an active one. The Aussie dollar even is looking good for continuation or potential reversal, though this one's much more dependent upon risk-based trends. A lot of opportunity, but you must keep in mind that these are markets not running just yet on risk-based trends. So place your trades based upon the fundamental themes that you expect to actually sustain influence over the market, and make sure you place trades with a time frame that is realistic with what the conditions are that we have. Good luck trading out there, guys, and I'll update you for the next week, which we have a lot of event risk, including Chinese GDP, as well as a number of Bernanke speeches and testimony to the semi-annual policy update to the both houses of Congress. But we'll update both of those and more tomorrow.